Welcome everyone. We are live, sitting today in Hong Kong with Mr. Ray Barros.
Hi,
How's it
everybody.
going?
Hi, fine. Thank you, Etienne.
Now, Ray, I want to ask you first. Just introduce yourself. Tell people what you're doing these days.
Sure. Essentially, I retired the hedge fund. I had a private limited hedge fund from 2000 to, no, sorry, 1990 to 2010. We started with 20 mil, and when we finished, it was at 943. Close it off. And since then, I've been trying to run a school, which has been started off well, but lately it's become difficult to attract the students. I'm hoping that's going to change in due
Mm-hmm.
course. Apart from that, I'm trading my own. Oh, I've got a small, 20 million. I'm trading an account for myself and my family and a couple of friends. So
Mm-hmm.
still in the trading game.
Interesting. What I want to know is how did you get started in trading? And that probably comes back to a few years ago. So how
Oh,
did that happen, and what was the story behind it?
okay. You got to go right back, right? My dad was one person who wanted the best for his kids, and the only imposition he said was, you've got to have a degree. Now, as far as he was concerned, you didn't get a degree, you weren't going to make it in life, and so you could get a degree as long as you got a degree. I got a law degree. And I must say, I didn't mind the law, but when I was starting, I ran my legal practice. I spent more time managing the practice than doing law, if you know what I mean. So I wasn't real happy at it. And then one year, my father-in-law said, "Come down to Hong Kong. I've got this great new way of making money." And we started trading the Hong Kong tail market. And it wasn't hard, It looked to me, it was trading a very nice top range, and I thought if I can sell the top and
Mm-hmm.
buy the bottom, you know, easy money, right?
Mm-hmm.
And I did that for about, I was supposed to stay for about 4 weeks, ended up staying about 6 or 8, something like that. And at the end of that period, I made enough money to be able to buy my wife a fur coat, and I had a little bit extra for myself. Uh, so I thought, this is it. I love this. Time's my own. I'm going to get to trade. Talk to my wife. I said, I'm going to sell a legal practice. And she said, yep, we're all in agreement. And just before I left, last 10 days or last week before I left Hong Kong, gold broke out. And the 10 or 15% I'd kept for myself, I blew the account. But I ignored that. I just said,
Mm-hmm.
I'm not going to worry about that. Sold the legal practice, and 12 months later, I'd blown all the money from the legal practice. So that's how I got started.
Okay, okay. And then I guess that kind of goes back to the same story most reach out to this have, which is they start well, they have a bad period, but then the question is how do you recover from that?
That was, if you ask me how, my wife's going to kill me because she hates me telling this, but if I have to put the success, call it blame, if I blame anybody for my success, it's my baby, because for 7 or 8 years, the first successful year was 1987. Sold the legal practice in about 79, 80. So that period, that 7 or 8 year period, the only reason I kept afloat, because I lost about 750,000 Australian dollars. Now
Mm-hmm.
you're talking a couple of million nowadays in today's currency. That
Yeah.
was 19. She was the one that supported us, and I'm basically got to really understand what trading's all about, the probability and so on, when I did a course with Pete Stettelmeyer in Chicago. And she was the one that funded that, and she was living on $25 a week. So tell you asked me how I turned it around. Firstly, you need the support of your wife,
Yeah,
especially someone
yeah,
like
yeah,
Chrissy.
yeah.
And then I think I came to realize, and that's what Pete taught me, that it's not about patterns. It's not about, it's about the psychology of buyers and sellers. And yes, the profile is something that will identify that for you. At
Mm-hmm.
least it did for me. But it's always about the psychology of the buyers and sellers. You've got to get in there and say, what is this chart telling me about whether the buyers have exhausted themselves, or whether the sellers have exhausted themselves, or we're trading a value area where there's fair price for both parties.
Mm-hmm.
And I think that to me was the key. My understanding of the markets came from that idea.
Mm-hmm. Mm-hmm. I also look at the market pretty much the same way or in a similar way, and I'm curious to know. So for someone starting out who don't doesn't know really how to apply this, how should they apply? Because that can be very subjective. Like you look at a
Absolutely.
chart and you have to identify yourself.
Well,
So.
to answer that question, you need to understand the way that I look at how people improve.
Mm-hmm.
And I think one of the critical things that you need to learn as a trader is to execute a trading set of trading rules, call it a trading methodology, that has a positive expectancy, that has an
Yeah,
edge. Yeah.
yeah.
And no matter what happens in your life, no matter what's happening to the results, that's irrelevant as long as the methodology is work, it has that edge, then you got to keep executing it. So I really do believe, depend, doesn't matter whether your personality is better off as a discretionary trader like I am,
Hmm.
or someone who is mechanically inclined. I think you should start with a very simple mechanical system and make sure it's got an edge, obviously some
Hmm.
sort of edge, but just learn that trading is involves execution of a methodology irrespective of what's happening emotionally for you. You
Yeah.
know, you handle your emotions, but you have to execute that plan. Once you get that under your belt, then you go on to other things. You can
Hmm.
become a discretionary trader because by then you've understood, okay, I find a way, a set of rules that will work for me, I'm going to follow them, and
Hmm.
we go from there.
Of it. And how did you create your first plan? Because that's something a lot of people struggle with. They hear I need to create a plan, but then how to do it, that's kind of the hard part.
How to do it? Well, I'm not sure. I don't quite understand the question. If you're trading a mechanical plan,
Hmm.
then essentially you either buy one that has an edge, and just be careful you don't. You know, anybody that says I've got a plan that never loses or I've got a
Yeah.
90% win rate, put that away, right? But if you find something that actually has, you know, even if you copied something like a Churchill's formula or something like that, just something that you acquire the skills, or you send it out to a third party to test the plan for you to make sure that with a bit of back testing, that will show you the pitfalls that your plan might have or whatever. But you have a very simple set of rules, and that's what I would start with. In the school that we teach, for example, we have separate levels, but the first level is for people who've never traded before, and we give a mechanical plan, which we tell them it won't work where the it's a plan where you enter the market at the beginning of the week and you more or less get out by the end of the week, maybe a week
Hmm.
later. So, and it's directionally, it call it a short-term swing trending
Hmm.
system. And what happens there is it won't work where the market is not moving directionally. So if the market's like that, it's not going to make you money, and you have to recognize that.
Yeah.
Um, so for me, that's what I think. That's where people have to start. They have to start at that level rather than get involved with Elliott Wave or Wyckoff or
Hmm.
whatever. Yeah.
Hmm. And I feel like a lot of people can to caught up in like finding the right indicators and using indicators to trade, or finding this method and then they hear about this one, and yeah,
Yeah.
changing too often. Yeah.
Yeah, they don't give the method a chance.
Yeah.
Yeah, you know that's the problem. I mean, you get, but partially it's our fault as educators. If I, oh, not our fault, but part of the education that is out there is promising you this holy grail
Hmm.
where you can't lose. You get people actually saying, "Take my system and you
Oh
can't
yeah.
lose
Yeah.
money."
Yeah.
Yeah, or I have a 90% win rate, or all this.
Yeah.
Don't get me started.
It's incredible. Dude.
It-
There's a lot of stuff, and I got some email recently about that topic for sure. That's quite bad. And guys, we'll get to the question as always. Comment in the chat. I know we have a few questions already, but I want to know, how did you transition from starting to trade to starting to manage funds? Did that happen like automatically, or was
No,
it
no, 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 it
over
didn't.
time?
What happened was I had a really good broker called Damien Hatfield. He's no longer a broker. He's retired, I think, in Australia. I was in
Hmm.
Sydney at the time, and he was working with a broking company called ANZ McCorns, which I think has since closed. I could be wrong. And he saw my trading results and said, "Right, I think you could be successful in this area,"
Hmm.
and he got me interested. The thing with Damon was he suggested a route that I wasn't particularly happy to take. In my day, and this is going back, what, 1990, so we were about 88, 89, something like that.
Hmm.
Um, you'd have to go to all these shows because to be a hedge fund manager, you had to be a futures. There wasn't Forex wasn't very big and CFDs were non-existent. So you went to all these shows where there were CPO, commodity pool operators, where they would give you money for other people. You had to get a license, of course.
Hmm.
The problem with that is that commodity pool operators, one of the big names, they didn't want to give money to guys who were unknown. We were like prostitutes, I guess. Come, give me some
Thing is,
money.
okay.
I went a different route. I decided that wasn't for me, and I'm very lucky that my father was very well known in Hong Kong, um, and my wife's family was fairly well established. So we had a number of contacts, and I picked up a little bit of with my legal game, picked up a few people instantly.
Mm.
So we managed to raise IPO, call it an IPO for 20 mil. That's how we started.
Okay. Okay. And that's pretty big for some people starting out, and maybe watching this. Maybe they have a low expectation of starting with just like $100,000 or something.
As a fund.
Yeah. Well, as themselves trading, I guess. So
Well,
of course for fun you need more.
100,000 is, I think, is a reasonable amount for people
Uh-huh.
to start trading.
Uh-huh.
I wouldn't sniff at that. I mean, if you're trading CFDs, for example, people are talking about starting with $500 and $1,000. I think is a little bit underfunded. Well, more than a
Yeah.
little bit
Yeah. Yeah.
underfunded.
Yeah. Yeah. Of course.
But no, 100,000 is fine. You know, if people start with 20, 50,000, I think it's quite. You can't make a living trading. In my view, cannot make a living making 20 and 50 because I think you don't have to be the world's best trader to be successful.
Mhm.
But really, your gains are somewhere between the 10 to 20, 28 maybe top end.
Mhm.
Uh, of course, if you're something like Medallion's Renaissance Fund, it's a whole different ball game, right? But
Yeah.
he's the best in the world at the moment.
Uh-huh.
So the average person is going to make somewhere between 15 and, if you're really good, around 20. So let's say 15 and 20, 22% is on average. Anything above that, you're starting to become exceptional.
Mhm.
So look at if you're earning $100,000 a year, if you have $100,000 capital, you're making 20,000. I mean, what kind of lifestyle is that going to
Yeah.
give you? And you've got to
Exactly.
still put money in the bank,
Uh-huh. Uh-huh.
to build up the fund.
Yeah. To
So
grow your account.
100,000 is
Yeah.
not going to do a lot for you
Mhm.
in,
True.
in that respect. But if you have a job, 100,000 is a very good
Yeah.
start.
Yeah. So what would you recommend people who are at a point where they're profitable trading? They know they have a good methodology and they can trade. How should they go about trying to find capital to trade?
Well, there are a number of routes nowadays. First thing, you can actually set up a private limited hedge fund. I just was talking to a friend of mine at lunch yesterday or the day before, and they started off setting up as selling the services, basically an advisory newsletter, I think it was.
Hmm.
And then from there, they gravitated to long short fund.
Okay.
And I think they now have about 20, 30 mil under management. They started with six. Uh, and that's really one way of doing it. If you have good contacts, that's one way of doing it. Another way of doing it, that if you've got a profitable approach, go see some of the hedge funds. You know,
Hmm.
get to work for them, build up your contact. At the end of the day, it's a bit like any form of selling.
Yeah.
You need to build up your network of
Uh-huh.
people and selling its email list, right? So you get a good
Hmm.
email list, you've got possible purchases. So it's the same when you build a hedge fund. You've got to build up a group of people that are willing to take a risk on you. There are a few funds that are genuine that will actually seed money. If you're good,
Okay.
you go to
Hmm.
them and provide some money, and they provide the records, and they will provide the money for you.
Hmm.
But you have to be careful because there's a few scam artists
Yeah. Yeah.
around.
Yeah.
Yeah.
Yeah. I've seen a couple of those also. So how should you know about finding out if it's a scam or a good
Well, just
fund?
see, to me, it's you have to look at the deal, right? So,
Uh-huh.
for example, I won't mention the name, but recently a company in Singapore um, was a Ponzi scheme,
Hmm.
and it just went belly up. I think earlier this year, about January
Okay.
this year, and essentially they would come to you and say, "We will fund you. We will give you X dollars, but you have to pay us this. You've got to pay us this. You've got to pay us this. Got to pay us this."
Yeah.
And at the end of the day, when you look at that, and you're paying X number of dollars out, what are you getting in return? Now, most of these people that will fund you at worst will say, you got to take the system off us. And if you take the system off us, it'll cost you X dollars a month, and that's it. That's all you're up for.
Mm-hmm.
And we will give you thing, we'll take the losses and we split the profits with you 64, 60, 40, 70, 30. If you make X dollars, we'll go, that's their way, of course.
Okay.
If you make X dollars, we'll go 60, 70, 30 your way. So I've got a friend who started off as a student, and she essentially has become one of the best traders for this prop house. And she's like on a 90-10 split. She gets 90% of the profits, and they get 10%, and they take all the losses. But she's
Hmm.
very good at what she
Yeah.
does.
Yeah.
So that's, there's the ways to get money.
Hmm. A lot of some questions in the chat, and you guys, if you have any other question, comment in the chat as always. That's a good one from Chris. How did you start to manage money with 20 millions? So I think we talked about that. And did you have to prove them with a track record from
Yeah,
a bank and
absolutely.
audited?
Well, you need it. If you think of it this way, you've got money, and I come
Mhm.
to you. what I've got to show you is an audited track record.
Uh-huh.
I mean, it's got to be authorized by a
Yeah.
public notary or accountant. You've got to be able to show your bank, your broking statements, etc., etc. Um, as you become more famous or more successful, let's put it that way, and you're better known, a lot of that's less. It's not, as long as you're not looking for institutional money, then a lot
Mhm.
of that is not as necessary, if I can put it
Okay.
that way. People
Okay.
will take you. Well, Madoff's a great. I shouldn't
Yeah.
use
Yeah.
him, but that's a
Yeah.
great
Yeah.
example, right?
Right.
So, in the beginning, if you want to start, you need to build up a track record. You need to get an audited statement,
Uh-huh.
and you've got to pay for that, and be prepared to show your broking statements.
Hmm.
Mm.
Hmm. Any idea of like what kind of length you need? Do you need like a year or 2 years or?
Well, the longer the better.
Yeah.
I started with a 3-year track record, but remember, I was doing this with private money. Private individuals generally are less
Hmm.
demanding than institutions. The other thing I would add is, although institutions are the way that most people go, I think one of the problems with institutions is that they're not very risk tolerant or loss tolerant.
Hmm.
So the moment you enter into a drawdown mode, they're likely to pull the money out.
Okay.
So I've always preferred the high net worth private individuals.
Hmm.
The regulations aren't as tough,
Hmm.
and because you're not getting money from the public, you're getting high net worth, and the regulatory authorities assume that they know what they're doing, so they're less tough on requirements as far as that's
Hmm.
concerned. And don't think that, don't underestimate the cost of meeting requirements. It can be fairly expensive.
Hmm. Of course. And that's a good question. So some people I've seen, and we had a question about this earlier, the fact that some people have kind of a bad period in the beginning when they start to trade. They lose like a bunch of money. Should they keep that as part of the track record, or should they kind of discard that and have a brand new track record?
Yeah, I'm sorry to laugh, but you shouldn't. You
Yeah, it's
shouldn't just
okay.
if you start trading money.
Uh-huh.
So if you, I think you owe it to your customer to show the good and the bad,
Uh-huh.
right? So of course, if I when I first started trading, I said, okay, I'm starting from 1987 because that was my first successful year.
Hmm.
If 1987 for me started off, the first 3 months I think were losing years, so losing months. So
Okay.
I did start
Uh-huh.
from 1987 for good reason, because if I'd showed them anything else part of that, then there wasn't a track record to talk on
Mm.
to speak of.
Mm.
So you identify when you think you started making money, and from then on show the good and the bad,
Okay.
because when you start trading money for people, you're probably going to duplicate those results anyways.
Yeah.
So
Yeah. Yeah. Yeah.
people
Yeah.
might as well know about it.
Uh-huh. Uh-huh. Okay. That's a good point. So the way I was thinking about it is that the fact that since you lost, let's say, the first 3 years of your trading journey, for example, you
Mhm.
can still show that. It's still part of your success
Hmm,
story.
hmm,
It's still part of your journey. So
hmm.
I don't think investors would be afraid of that because that's like the beginning of your journey.
Absolutely.
Uh-huh. And the question is, how do you handle your drawdowns when you with either private or public investors?
How do I what?
How do you handle the drawdowns? Do you communicate with people or?
Oh, one of the things I learned, I can't remember where I learned it from. Firstly, when you show your track record or when you're trying to sell your services, you always explain what's your expected
Mm.
drawdown, what's your maximum drawdown, the severity of the drawdown, the number of months that you're likely to endure. If you have a situation where you are having a sudden, let's say, for example, I don't know, do you trade Forex?
Yeah,
Again?
Forex.
Okay,
Yeah.
Forex. Okay. So remember when the Swiss franc against the US dollar, they
Mm-hmm.
came collapsing, and
Yeah.
that
Yeah.
happened to
Yeah.
be long that day or whatever it was, and I had larger than normal loss. First thing I would do is pick up the phone, and I would call every single investor and say, listen, we've just had a humongous drawdown. It's
Mm-hmm.
outside the norm. I'm ringing you to explain why. I also do that for humongous profits. So that way they don't get conditioned thinking, okay, he's only
Uh-huh.
going to pick up the phone
Yeah.
when there's
Yeah. Okay.
something wrong,
Okay.
right?
That's a very good point.
So
Yeah.
that's one. The second thing is, you need to be able to communicate with them. I communicated with my people at least every month for sure, and I will always produce a bit like Warren Buffett's annual letter, except that mine was a
Mm-hmm.
monthly one. I would
Okay.
always write to them. And remember, we only had about 22, 23 people in the fund. It wasn't
Mm-hmm.
exactly a large fund. So um, communicating with them is not hard.
Mm-hmm.
If you have two or 300, that might be a different story.
Yeah. Yeah. But still, these days, with all the communication method, whether it's gonna be email, you can still do a minimum
Yeah,
dashboard.
exactly. I think that communicating with your clients at least once a month if you have a fund is an absolute must. And even if you don't pick up the phone, if you have a large loss, you send them an email or something.
Mm-hmm. Mm-hmm.
I think people appreciate that. At
Yeah.
least that my people did.
Uh-huh.
Yeah.
Uh-huh. But I guess even those even those periods, yeah, it's to have some people who withdraw money after big events like this.
Knock wood. I kept the same group of people
Huh?
from 1990 to I think 2009. I had a very difficult, a different structure to most funds.
Mm-hmm.
To understand why, you have to understand the view that I take is funds will take 1 or 2 or 3% per month. Sorry, per annum, monthly in arrears, right? So
Okay.
that's so if you're on 100,000 or 100 million, whatever it might be, they'll charge you 1% divided by 12 and take that each month. Okay. And that is because they need to meet their overheads. That 1% will only cover overheads as a general rule because our overheads are very high with
Yeah.
the fund. Then they'll charge you somewhere between 15 to 30%. Some charge 40% of uh, high watermark profits. In other words, every time you increase your profits on a quarterly basis, they're going to take X percent.
Okay.
So, for example, in March you had your fund started at $1 million. Then in June it goes to 2 million. Well, they'll charge you $1 million, a percentage of the $1 million you've made.
Okay.
If September your fund now goes down to 1.5, there's no performance fee.
Mm.
The following month, the following quarter, it goes to 2.5. You were at 2, you've made an extra 500,000, so they're going to charge you X percent on
Okay.
500,000.
Mm.
Now, that's very unfair to the client
Yeah. Of course.
because they'll never collect the benefit
Uh-huh.
unless they pull it out straight away.
Yeah.
So my fund is a little bit different. I said you're locked in for 3 years unless I have a drawdown of X percent,
Mm.
in which case the fund immediately closes. At the end of 3 years, I distribute the profits and I will take my money at that time.
Okay.
Okay. You're then invited to reinvest.
Mm-hmm.
So the first time I did that, you can imagine people took all the profits and reinvested the original capital,
Mm-hmm.
right? But as we moved along and they got comfortable, they actually wrote a couple of times, said, don't worry about redistributing, we're just going to leave it there.
Okay.
Then I had one really difficult period. I can't remember the years now, but 3 years I didn't make money. So I was thinking, this is the worst, right? When I closed the fund this time, I never got to my maximum drawdown,
Okay.
but I didn't make money for 3 years.
Mm-hmm. Mm-hmm.
If it'd been an institution, money would have been whipped out.
Yeah.
These guys didn't. Not a single person took their money out. And this was, of course, well into this 20-year period that I'd been with them.
Mm-hmm.
I only lost one client, 2008, I remember. 2007, I lost one client because we had just started a new rotation. And he wrote to me and he said, look, I'm really in desperate states, they're mainly professional investors. I lost blurb number of dollars with these other people because of the crash. Can you let me out? And so I said, well, I can't let one person out. I can let everybody else out, everybody at the same time. So we closed it, I think, a year into the fund and then started it again. The only one that didn't come in was him, which is fair enough. So I only lost about one client in that whole period.
Okay. That's interesting. I had a talk with the fund manager who basically what he does is every year he promises like a minimum return. And if he doesn't achieve that return, then he doesn't get paid.
Well, that's fair
What are your
enough.
thoughts on this? Would it be a good method to go
Um,
with, or
Well, in essence, I think year to year, it's if you don't make a minimum return, you've got to be confident enough to do it, right?
mm-hmm,
And
mm-hmm.
depends on you, really. I mean,
Yeah,
I think it's very fair to the client.
uh-huh, uh-huh.
It's a question of whether you're able to survive.
Yeah,
Because let's face it, that I said the 1 or 2% is going to meet your overheads. So if the client makes X percent, you don't make any money for that 12 months.
mm-hmm.
Can you survive for the next 12 months? That's really
Yeah,
what it comes
yeah,
down to.
yeah. Right.
Because you got
Good way
your
of saying
12
it.
months of overhead, so it's a matter of it matter for the client, matter for the hedge fund manager.
Mm. We had a question from Kimo about your trading style and kind of what you analyze in the market. I know we've talked about a little bit the kind of how the market moves and things like that, but is there anything else you look at in the market?
Oh yeah, I mean, my approach to the market is basically Wyckoff and a market profile. Developed a tool I called Barros swings. It's a bit hard to show without a chart, but if you look at any time frame chart, let's say you look at a daily chart,
Mm-hmm.
you've got one, you've got intraday buyers and sellers. You've got people who buy and sell within 1 or 2 days. You've got people for a week, month, and so on. All of these are within that one chart,
Hmm.
and there's very little out there that distinguishes the different types of time frames. And so Barrow Swings does that, and it's
Okay.
in the Nature of Trends, which you
Uh-huh.
nice enough to. That was Nature of Trends all about, really,
Yeah. Okay.
what Barrow Swings were about. So I use Barrow Swings a lot, but the context of Barrow Swings, I mean, all Barrow Swings is just a tool to identify time frames. The context of that, the theoretical context of that, is Wyckoff, and then I thought market profiles took the Wyckoff theory to the next stage.
Hmm.
So they can combine together, and basically both of them looked very closely at the relationship between volume, range, and type of trend.
Hmm.
Now QE put a damper on that, because with QE, essentially people thought this is never going to go down. Simply because the government, if it does go down, is going to jump in, and they were right.
Uh-huh.
We had the sustained trend, and then we had the Trump, what I call the Trump rally, which
Yeah.
we've also had. And it's only recently now, in the last couple of weeks, that we're starting to see markets return to normal,
Hmm.
where you're starting to get some very large pullbacks.
Yeah. Yeah.
So that's essentially the way that I look at the markets. Now, for any discretionary rule-based trader, I think there are certain elements you need to look at. So, questionnaire I give my students to say, what's the trend of the time frame I'm trading?
Hmm.
Is it likely to continue or change? So that depends. Answer to those questions depend on my strategy. Am I going
Hmm.
to be long, short, or if I can't answer them, then I stay out. Once you've identified the trend, you're looking for zones, setups, entry bars, initial stops. They're the next four things that will be part of my plan. And then I look at my trade management. So if I'm in profit, how am I going to manage the trade?
Hmm.
Which I think, of all the things we've talked about, except for trend, that is the most important. How do you manage a winning trade? And that's going to make the
Yeah.
difference between a really good result and something that's mediocre.
Do you have a preferred style of doing this? Because some people like to take partial profit or move their stop loss to break even.
I have a belief about, and I'm going to answer that in a complicated fashion. I'm sorry. I have a belief about the way that we interact with the market, or our plans interact with the markets. There are times when it's normal.
Hmm.
And in that situation, what I call normal times, I will use a thing that called partial exits, where I exit the first third, usually twice the initial stop, so that when I exit the first third, I'm at break even. I leave my
Hmm.
stop where it is on the remaining 2/3. So if I take it out and market comes down and stops me out, let's say I'm long, then I won't lose on the trade.
Hmm.
My idea is always preservation of capital.
Okay.
Then the next set of thirds is when I get out at a logical objective, and that's where I need to get to make money. I really need to get this second set of profits. The last third is what I call a blue sky, and that is basically, and one of those trades where, wow, this is
Yeah.
going much further than I thought,
Okay.
and that's usually trailing stop
Okay.
or change in trend pattern.
Okay.
So that's when it's normal. There are times when I'm in ebb stage where everything you do is wrong. You've got the super duper setup or super duper, um, I don't know, pattern of entry, whatever you want to call it,
Hmm.
and it just fails. So if you buy, the market goes down. If you sell, the market goes up. Just what I call ebb stage. I handle that by getting into a trade and exiting very quickly. So, for example, the moment the trade goes one ATR from entry and I'm in ebb stage, I will immediately exit half the position, and I'll put my stop on the remaining position at break even. So, very different to the rule of
Hmm.
three.
Hmm.
When I'm in flow stage, that's the point where everything I do is right. You
Yeah.
get those occasional,
Easy markets. Yeah. Yeah.
yeah, well, easy markets, easy for you. There, I will ride. I will actually ride rather than take out partially. I will add to my positions. I do almost a turtle thing where I will let the market stop me out when I'm in flow stage, because
Hmm.
literally what I'm in sync with the market. I cannot do anything wrong. Just got to be careful you don't get too arrogant in those, because the
Yeah.
market
Exactly.
turns around.
Exactly.
You're in deep shit. Excuse the word.
Uh-huh. That's right. I guess for some people it's gonna be hard to define what period of the market we're in now and what happens, because you can have a couple of loss, but then does that mean you change your style?
Yeah, well, to me, it's not so much it's you and the market. It's the
Uh huh.
way your market is, either yourself or your plan, if I can put it that way. And yes, it's going to always be a little bit with benefit of hindsight, but you can
Hmm.
do it. I do it. I used to do it statistically. So
Okay.
if I had X number of losses, consecutive losses, or X number of percentage loss of capital, that would tell me I'm in ebb or flow or a normal stage.
Hmm.
But with experience, you pretty if you get to know pretty
Yeah.
well that
Yeah.
you're in a, you like I'm in reasonable flow stage at the moment. I got into a trade on the 30-year bonds,
Hmm.
and we were talking about it in class with the guys. And I said, well, I'm going to sell the market here, blah, blah, blah. Market tanks. And then this was only a couple of days ago. She closes off the lows. And so that at that night's meeting, I said, I'm out this morning. I actually sent an email out to the guys just in case they didn't look at the market, whatever. I said, we talked about this last night. They don't copy, but I want them to understand. And I'm
Hmm.
out of this trade as soon as the market opens this morning because it looks as though the selling is over at the wrong place. In the structure of what I look at, it was selling was over in the wrong place. I think it was about 143, 144, or what? We went to 146 last night.
Okay.
So those are the things that you get to know. So that to me is flow. Even though I didn't make any money out of it, I'm in sync with the market. I mean,
Hmm.
instead of losing money, I actually made a couple of bucks.
Hmm.
So that to me is flow stage.
Hmm.
So to answer your question, initially it's statistics, and then you pick up the intuitive gut feel that you know when you're in.
I love it. And so, what does your trading looks like in terms of kind of strategy and of yeah, strategy and time frame? Because I guess it's one thing to trade, but managing a fund is like a completely different thing. You have some more to do with that, and with classes after also. So how you manage all of this?
Oh, that's managing is not hard. I mean, I've been very lucky. My father was someone who managed his time and his
Mm.
thing. You know, a little bit off topic, but when he passed away, he left mom a set of instructions, and he anticipated what his company would do. He said, if they do X, you do this. Make sure you get my
Wow.
superannuation. So he taught me how to manage my affairs very well.
Hmm.
And one of the things that I learned and then relearned recently was that we work on micro levels. If we do things one small bit of at a time instead of trying to do everything at once, we actually get more done.
Oh yeah.
So I don't actually have problems with studies or well studies too because I'm considering always studying,
Hmm.
teaching, trading, and so on. That's not the issue. Um, I think that you can do that if you're prepared to organize yourself.
Hmm. Hmm. Absolutely, and I also believe in that because other people struggle with time. They have a job and they cannot trade,
Mm.
but there's so much ways to I think find
Well,
time enough.
for a start, if this is something I always tell, and this I'll pass on to the audience, if you have a job and you can't look at the market intraday, then don't trade
Yeah,
intraday. You can trade end of day bars. Yeah,
exactly.
the entry bars won't be as optimal, and your stops will be a little bit big, but so what?
Yeah.
You know?
Mm. And are you trading intraday or only on a
No,
swing
no. For
level?
me, I basically am what I call an 18-day trader, a monthly trend trader, right?
Okay.
But my entry is 60 minutes.
Okay.
So I will try and enter on the 60-minute bar
Okay.
because it gives me better entry
Yeah.
points,
Yeah. Yeah.
stops are
Yeah.
tighter. Uh, but you need that came with a bit of with experience. I mean, I
Yeah.
didn't do that straight away.
Uh-huh. And how do you manage this aspect of kind of being notified when it's time to enter? Because 60 minute chart for me is very hard to trade. I can trade it sometimes, but when I do, whenever I travel or I don't have time or I work or something, I tend to forget to look at the chart, and then I don't place trades
Oh,
on that
okay.
time frame.
Well, I don't know how to answer that question because I don't have that problem.
Okay.
For example, I will never enter, even if I'm trading 60 minutes on the Asian time zone if I'm trading FX.
Okay.
No, no, just don't want to know. And I developed a thing called so for some currencies, I developed a thing called flow, which basically says if something happens in the British time frame, the
Hmm.
European time frame, it will flow into the US.
Okay.
Okay, some currencies won't. Some
Hmm.
currencies, whatever, there is no relationship between what happens in the European time zone and the US time zone. They can be totally different.
Yeah.
Um, so I need to know what time zone I'm going to need to look at. So
Hmm.
mainly, if I've got flow, I'll be entering in the UK time zone.
Okay.
If I've got the currency that only does the US, then I've got two options because I don't stay up all night,
Yeah.
obviously. So I might stay up till about 11 o'clock or something like that. But then
Uh-huh.
I'll just wait for the end of the day.
Hmm.
So that's so I don't have to, so the morning session for me is free. So anything up to about 4:30, I'm fine.
Okay.
Yeah,
Okay.
Hong Kong time,
Yeah.
obviously,
Okay.
and then up to about 12 at night.
Okay,
Eleven o'clock,
that's a really
right?
good way to see it because I've never entered trades. I think since I travel in Asia, I never entered trade in the morning. Yeah,
Hmm.
always like later or yeah, on a forward chart it'll be later in the day and the 1 hour chart as well. So that's interesting. But I
Yeah.
didn't notice. So can you mention it? Just be happy. Um, we have a couple of questions here. So Greek and Tweak, can you ask his opinion on how to scale your trading account size and trading volume?
Say that
How
again.
to scale up
Oh, how
your
to
trading
scale
account
up? Okay.
size?
Well, scale up for me, for a start, is you separate into flow, ebb, and
Uh-huh.
normal. So my normal size, as we'll talk about in a moment, ebb will be somewhere I can reduce it as much as 75%,
Okay.
depending on how what level of ebb I'm at.
Uh-huh.
And flow, I will increase it as much as 2.5 times my
Okay.
normal size.
So you change your position size every time.
Well, I change my position size depending upon what stage I'm in. So,
Mm-hmm.
these stages can last
Yeah.
2 or 3 months.
Okay.
So it's not as though you're changing it every trade.
Uh-huh. Uh-huh.
Normal size is a function of two things. I do use the Turtles formula for to assess position size according to volatility,
Mm-hmm.
and then I use what's my stop relative to my entry, how much am I prepared to risk, and the lesser of the two contract sizes is what I'll use. So if Turtles say I can trade 100 mil, and the stop says I can trade 50, I'll trade 50. Now, one thing that beginners don't realize is this idea out there that I should trade 1 or 2%.
Mm-hmm.
And that's fine as the starting point when you don't have any stats.
Yeah.
But when you get your stats going, 1 or 2% may be too big or may not be big enough. Because at
Mm-hmm.
the end of the day, it's a function of two things. It's a function of what is the probability of consecutive loss given your trading plan,
Mm-hmm.
and what is your average annual return. So, for example, if your average annual return is 15% and you've got a probability of consecutive loss of 8, and you risk 2%,
Yeah.
that's 16%. You just wiped out. You're running a risk of wiping out your whole year
Mm-hmm.
with one set of consecutive losses.
Mm-hmm.
So to me, someone like that should be risking about 1/4%.
Mm-hmm.
On the other hand, if you've got someone who's doing 15%, probability of consecutive loss is 2. Well, 2% is probably going to be too small.
Yeah.
So I like to say you should risk about half of your annual, for probability of consecutive loss, should be
Mm-hmm.
about half of your annual average return.
Okay.
Yeah.
So that if you hit that, then you lose only half of your yearly
Exactly,
profit.
of your
Okay.
yearly profit. Yeah.
Okay. That's pretty good. And I guess the follow up question to that, because so when you talk about how to scale your trading account size, I guess that means how do you build kind of a small account to a bigger account?
Okay. Well, first off, I'm a firm believer that you don't leave all your profits into in the account.
Okay.
So if you've had a certain amount of run, you want to pull something out and you want to enjoy that of it. So that's
Mm-hmm.
first thing. The second thing is, if he's talking about building up your account size, how much do you use? I don't believe in, how am I going to put it, just calculating your positions based on each profitable win or each profitable loss,
Mm-hmm.
because of the asymmetry of loss and asymmetry of win problem.
Mm-hmm.
Because if you keep just, okay, I'm going to risk 2% of my capital size, and you've had a good run, your highest position is going to be, you will contain the biggest loss
Yeah.
by definition. And when you're losing money, your smallest position will be when you're going to make money.
Mm-hmm.
Right?
Mm-hmm.
So you need to, there was a guy called Don Scott. He was, when I was in Australia, he was not a trader. He was the first professional punter, horse racing punter.
Okay.
And he used to say, the amount that you risk has nothing to do with how much you've made or how much you've lost. Has everything to do with the probability of today's success.
Uh-huh.
So what I do is I say, okay, I work out how much money I need to make percentage of capital before I will add it to my account. How much
Okay.
money do I have to lose before I will deduct my account?
Mm-hmm.
So that takes care to a certain extent of the asymmetry of risk problem.
Mm-hmm.
So that's what I would do. So for example, let's just say I make 25% per annum. So anytime I make half of that, I will then, only when I make half of that will I add it to my account. If I'm adding every time I make 12, I will reduce my account every time I lose 6. So it's
Okay.
by losing, I take it out more quickly
Mm-hmm.
than when I make money. So that's
Okay.
that's how I size up.
Smart to do it. Love it. And in regards to trading, what kind of market do you trade? Do you trade pretty much everything you
I
see
don't
you
trade
have
the
moves?
softs. I trade the financials mainly.
Okay.
Occasionally, I'm tempted to trade the soys, but I've been promising to trade the soys for about 30 years.
Okay. Okay.
S and P's, bonds, interest rates,
Uh-huh.
foreign exchange,
Okay.
gold. Yeah,
And do you apply the same method to everything or
same
different
method to
methods?
everything.
Okay.
No, same method. I'm not
Okay.
a mechanical trader, so if the theory, Wyckoff and market profiles stand up, as long as it's a free market, I think these theories apply. And yes, certain government actions will affect it, like QE
Mm-hmm.
affected
Mm-hmm.
its idea of volume and range, but they'll eventually come back. You just make
Okay.
adjustments.
Okay. That's a good insight. And what I love is the fact that you have a process for pretty much everything. So you really organize.
Yes,
And some people think discretionary trading is going to be like very, very kind of easygoing and things
I
that
don't
are
think
not
it's ever
planned.
easy
Exactly.
going.
So
Yeah,
it's completely different, which is what people have to understand sometimes.
yeah.
So what would be your advice for people who want to get into discretionary trading?
Well, as I said, firstly, you got to understand that you got to get into the discipline of executing your rules, whatever they
Uh,
might be. Because discretionary trading, the rules with discretionary trading are pretty straightforward. You follow your rules, but you have a rule that says that allows you not to follow your rules.
mm-hmm.
But in order to do that, you need to know that when you don't follow your rules, you're actually going to have an edge. You not, oh, I got up this morning and the sun wasn't up there, so I'm not going to follow my rules today. That's not going to work.
Yeah.
So for people who are discretionary traders, I would suggest to you that you test everything.
Mm.
There's a software called EdgeWonk, which I really
Yeah.
love, 169 bucks or something. It's
Uh-huh.
really
Yeah.
inexpensive
Yeah.
and
Yeah.
worth every penny. And they have this alternative strategy, and I fully recommend people utilize that to test their strategy. So, for example, I exit on a trailing stop of 30 points. Let's just say, for argument's
Mm-hmm.
sake, what happens if I don't have the trailing stop? Alternative strategy one. What happens if I trading point of 60 points?
Yeah.
And you're still following your rules, but then you're also testing at the same
Mm-hmm.
time. So
Mm-hmm.
you don't have to get someone do it for you. You can do this yourself
Yeah.
while you're
Yeah. Yeah.
trading. And honestly, the insights that you get when you do that is incredible.
Uh-huh. This is interesting because you could do the same thing with like a and back the it over there
Yeah.
like in the past, but that would take more time as
And
opposed to
and you need
combining
the
this.
expertise.
Yeah,
Yeah.
as opposed to using your live result to
Hmm.
test it. That's pretty good. Would do it for sure. What kind of maximum drawdown and minimum return do investor look for?
Wow, that's really a matter for you, right?
Yeah.
For me, I know my theoretical, it used to be around the 28% mark. That was the maximum drawdown I had in those 3 years
Okay.
that I was telling you about.
Uh-huh.
Um, in the last 5 or 6 years, I've reduced that. Yeah, through one of my students. They said something one day. I thought that sounds interesting. So when I go into ebb stage, I'm cutting my positions more quickly.
Hmm.
Um, but I can't very well give you it. So, some people might be happy with a 6% return.
Hmm.
Okay, if you're happy with a 6% return, then your maximum drawdown should be no more than 6%. Very,
Yeah. Uh-huh.
obviously, I prefer it to be around 3 or 4.
Okay.
Um, if your return is 40 50%, then obviously your maximum drawdown is going to be more. This is such an individual thing. I
Hmm.
find it a very difficult question
Hmm.
to answer.
And the other thing is the fact that you could always risk more and have a bigger return or bigger drawdown.
Yeah,
So
yeah, absolutely.
6% of
Yeah.
the risk. Yeah. Interesting. So if you guys have any question for Ray, comment in the chat and we'll make sure to answer those. We have a couple more to go. And what do you see most traders do wrong in the market these days, especially people you teach or who come to your seminars?
Okay. It's human nature for a
Yeah.
start. We recently had these group of people come through, right? And it's not. I don't consider my fees exceptionally high,
Hmm.
but they're not really. It's not $100 or
Yeah.
anything like that. So they're paying roughly about 2,500 US dollars.
Hmm.
One guy did absolutely no work.
Yeah.
Okay, none at all. One guy did, so he didn't learn it. By the time we got, I was explaining to you the way the courses runs. By the time we got the practical side, he couldn't do any of the practical side because he hadn't done any of the theory.
Hmm.
One guy did all the theory but wouldn't trade, just would refuse to put a trade on.
Uh-huh.
There's always a reason why he wouldn't put a trade on. Then we had about half a dozen guys who were wonderful. I mean, they did everything an instructor, educator, whatever you want to call us, would want. They did the work. If they didn't understand, they would harass you until you explained it to them. And
Okay.
then when they went to trading, I won't say that they all made a ton of money, especially in the current market conditions, but they
Hmm.
all had a process that they followed. And I have every confidence that when they leave the course, they will be, continue the success that they've had
Mhm.
in follow, because the process is a good one. They've got to, we back tested their plans for them, and their plans for me, as far as I can see at this stage, given the limited amount of trading, it's fine. It has an edge. So if they continue executing the process, they will make money. And
Mhm.
then as they become more experienced, they get the nuances, they will improve on that.
Yeah, yeah, and it's also a matter of continuously improving
Yeah,
on a
absolutely.
daily basis or weekly basis. Yeah, and I guess that leads us to, yeah, how are there any? Do you have any advice you'd like to give people in terms of that, or because I feel like a lot of people, they wanna, like, they like to learn, but they don't like to work harder to apply.
Yeah, I think trading is the hardest profession in the world for two reasons. Firstly, it's against human nature.
Uh-huh.
We have to accept that losses are part of the game.
Yeah.
We have to accept that consecutive losses are part of the game. And if you don't prepare to accept that, then walk away, because
Mhm.
it's never going to happen. Secondly, you have to work at this. This is something that you can't sit down and read a book, sit down for an exam, you get high marks. That doesn't mean anything.
Yeah. No. Exactly.
Yeah, you got to go out there and practice.
Uh-huh.
Now, there's a thing that Anders Ericsson came out with called deliberative practice,
Mhm.
which basically teaches us how to turn knowledge into a skill. And one of the essential elements is practice with immediate feedback, which comes back to, I think you're producing a course with a coach. I mean, that to
Yeah.
me is critical,
Uh-huh.
because the Erickson's work clearly shows that if you don't give immediate feedback, the longer the time between action, result, and feedback, the longer it takes a person to learn.
Hmm.
So trading is about the only really tough position in the world that people don't think they need a coach.
Yeah.
And I really have a thing about that. I really believe that if you want to succeed, you want to be the best in the world, or best you can be, better way of putting
Hmm.
it, you need a coach.
Yeah.
If you want to be a weekend golf player, then fine. You want to dabble, yeah, go ahead. But if you don't, you need a coach. I mean, imagine someone like, what's the name of that tennis player who won the Australian Open? I'm not a tennis fan, but I love, my mother loved him. uh, Federer.
Uh-huh.
Imagine Federer getting to the top of his profession without a coach. It's just,
Yeah.
it's nonsense, right?
Uh-huh.
So my advice to people is, if you're not prepared to do the work, then accept that you're going to be a weekend trader. Put in very small amounts of money, trade very small, and have your fun, but be prepared to lose whatever you've put in.
Hmm.
If you really want to be as good as you want to be, then you need to get coached. You need to put the education in, and you need to put the time. The fact that you spend money getting a coach doesn't mean anything if you don't
Yeah.
practice.
Exactly. Yeah. It's kind of easy to say I've paid for a coach, but then I didn't do any work.
Yeah, exactly, which is not going to get you anywhere, right?
Yeah, right, right, right. That makes total sense. And I want to remind you guys that the link for Ray's books can be in the description below if you want to check out his book. And how can people find you if they want to connect with you or reach out?
Yeah, I think the best thing for people is I write a blog about 4 times a week.
Nice.
So www.tradingsuccess.com/blog.
Okay.
And I've been getting some really good feedback on the blog. Yeah, that's been
It's
good.
awesome. I think that's right because people can get some inspiration on a like daily basis, which
Yeah,
is
yeah,
interesting. Yeah.
exactly. What the way I've organized the blog is Monday, Tuesday tends to be market commentary,
Hmm.
and then Wednesday is a teaching day. Try and find something that people need to learn, and the fourth one is the one that's interesting. Thursdays I try and find things outside trading that would be of benefit to traders.
Yeah. Yeah.
Yeah, so that's the way the
There's a
blog is
lot of those.
organized.
Yeah. Yeah.
There's a lot. Yeah, so in different areas.
Yeah.
Yeah.
Do you have an example of things outside trading that can impact your trading, or that you can apply to trading very easily?
Well, for example, the importance of getting enough sleep,
Yeah.
nutrition, exercise. The modern breakthroughs in memory and learning, I think, is the biggest area at the moment that will impact, it's outside trading,
Okay.
that impacts traders. Yeah.
I like it. A couple of questions just came in. That's awesome. Do you meditate?
Yes.
Okay.
Uh, take this is really important. Oh, I can actually pass this. There's a thing called acceptance and commitment therapy, or acceptance and commitment trading, by a guy called Harris, Australian. And to me, that has been the biggest breakthrough in the psychological world, because he was shown that drug addicts, wife beaters, alcoholics, and so on could obtain immediate benefit. Well, immediate being within 2 or 3 months, as against 2 or 3 years or 10 or 20 years of normal cognitive therapy.
Mm.
And then Gary Dayton, Dr. Gary Drayton, started applying it. He wrote a book called Trading in the Flow, I think, something like that. Anyway, Drayton, it's a good book. And he mentioned in there that he was using ACT in his work.
Hmm.
So I thought, oh, that sounds interesting. So I went into
Okay.
it. And then I found ACT really is very useful because ACT separates two things. It separates the left brain stuff, which I call the left brain, how to set goals, make sure you have your values. That's the traditional way of getting to point A to point B. But the other side is the mindfulness approach. And he combines, my ACT combines the two. And you know those times when you're sitting in front of the screen or you're looking at it and suddenly you think, well, the other night when if you were long or short the bonds, you would have had this experience. Powell came out to speak, right?
Hmm.
So the bonds are rallying really strongly and looked as
Okay.
though there was no ending. So he said something, bang, the market drops. In those times, the ability to manage yourself, to say, what is the market telling me rather than, oh my God, I'm losing money,
Hmm.
that's so critical, and that's what does for you,
Okay.
and mindfulness does for you. So
Hmm.
yes, I do meditate.
Hmm. Interesting. Have you seen the difference between either, like, let's say, traders in North America compared to here in Asia or Hong Kong? I feel like people are more willing to meditate here compared to in North America. Unless
Oh,
it's only me, but
actually, I don't get that feeling. I don't get the feeling that people in Hong Kong and China are into the meditative self
okay,
awareness thing
okay,
as much, say, as the US.
okay.
uh, as I said, I just came back from Los Angeles doing a course, and they're all about self awareness, looking inside their
Hmm.
own, and so on and so forth. The East basically says very practical. Where do I buy? Where do I sell? Just make me money. What do I do?
Okay, yeah, yeah, yeah. Love this. In addition to your book, you also have a few trainings or programs. What can people expect from that? And
Okay.
what is it about? Maybe give a small description.
Yeah, sure. Basically, I'm trying to set up a school.
Hmm.
So we start at the basic level, and it's the person who's never traded before. We usually give a mechanical system. We tell them where the mechanical system won't work. We give them rudiments of money management, and try and get them in terms of the psych stuff on how to keep your journals, to get consistently keep your equity journal and keep your psychological journal, and what to draw from them. So that's your basic level. The next step up, we try and give them the theories that I think are very, very useful to the markets, which is Wyckoff and market profile, and show them how to create a discretionary rule-based system, and then take the next step further, how to use that information to create a trading plan.
Hmm.
Next level up is the actual, what I call Ray wave. I won't get into that. It's an objective uh, Elliott wave because I find that very useful for long-term forecasts, and market profile, which is very useful for entries and
Hmm.
exits. And then we have a course called Ultimate, which basically is teaches nothing except how to execute your plan on a consistent basis. So that it's like a little think of high school or kindergarten through to university level.
Okay, powerful. That's great. And I guess that's gonna be we can conclude on that. So, what would be your advice for people who have a lot of technical knowledge on how to trade, the patterns, indicators, everything, but they cannot make money or they have problem with emotion when they come to trade?
Okay. Um, First off, I think preparation is going to be your key.
Hmm.
If you have a set of rules, if those rules have a positive expectancy and you're not executing them, let's put it that way, then the best thing you can do is to prepare for them before the trade. What does the market have to look like for you to enter the market? And then in terms of trade management, what does the market have to look like for you to stay in the trade? What does the market have to look like for you to say, look, this is not working, I'm getting out?
Hmm.
And to really, you talk about meditation, to visualize that, write it down at whatever form of visualization it works for you, whether you do it mentally, whether you write it down, whether you put it in record or whatever, but go through it so that it becomes automatic, so that when the time happens, you don't not do it, if I can put it that
Yeah.
way. So if you've got to stop at a certain level, people talk about putting stops and they don't really think, I'm going to lose money. I want you to think about, okay, if I'm going to put a stop here, I'm going to see the market hitting my stop. I'm going to see myself losing that. And it's okay because
Hmm.
it's only this one trade of the next 10,000. It's not the end of the world if I lose on this trade. And if they do that, they're going to be much more disciplined.
Love it. I think that's powerful advice. So, Ray, thank you very much for the interview. I
Thank
think
you.
people will like it. If you have any question or any comment for Ray, comment below. And we'll make sure to monitor those comments and give a like if you enjoyed the video today. And we'll catch you guys pretty soon.
Okay, Guy. Thank you.